Gold was one of last year's star performers within the commodity complex as the combination of fiscal policy and high inflation expectations helped to drive it to a new all-time high. Since the end of last year, however, its performance has sagged when investors started switching their attention towards reflation assets. Saida Litosh explains some of the demand dynamics affecting gold in Q1 of this year.
In Q1, we saw a rebound in physical gold demand, which was up by 25% year on year. And this was driven by gains in jewelry demand and retail investment. Jewelry demand, which roughly accounts for half of global gold demand, was probably one of the worst, if not the worst, hit segments by the pandemic last year. Demand from this sector recovered by over 40% in Q1, and this was to a large extent driven by a recovery in key Asian markets, including India and China, where demand revived from the lockdown hit Q1 2020 as the economies continued to re-emerge from the pandemic, helped by the festival period and also lower gold prices in local currencies. Now looking at retail investment, which is investment demand for bars and coins. Demand rebounded by over 40% in Q1. It was driven mainly by a resurgence in demand in Asia as economies continued to re-emerge from the pandemic and recover from lockdown. There was also an element of opportunistic buying as lower gold prices in many local currencies were seen as a good opportunity or a good timing to re-enter the gold market, especially given the expectations about the price outlook. In addition to that, retail investment demand in the Western world remained quite strong in Q1. And this was driven by ongoing concerns around economic uncertainty, currency stability, and growing inflationary pressures, given massive stimulus measures introduced by central banks and national governments to pull economies out of the deep economic recession caused by the pandemic. In a sharp contrast to that, we witnessed a shift in investor sentiment towards gold among the professional investor community, which pretty much started towards the end of last year and sort of accelerated since the beginning of this year. This was evidenced by liquidation from ETF investors who reduced their global holdings by over 170 tons in the first 3 months. Just to put this into perspective, gold ETFs witnessed a record level of net inflows of around 900 tons over the course of last year. Q1 selling represented the second consecutive quarter of net outflows, with net selling of 75 tons reported in Q4 2020. This compares to net inflows of over 300 tons witnessed in Q1 last year, and also represented the largest net quarterly outflow since Q4 2013. Another sort of weak story here is official sector buying. Central banks' gold purchases were estimated at around 81 tons in Q1, which was down by more than a third year on year. And this was driven by a sharp increase in gross sales led by countries such as Turkey and the Philippines, but also a year-on-year reduction in gross purchases.
Retail investors have been buying into recent weakness, especially in Asia, but institutional investors were unwinding because of the improved outlook of growth and anticipation for higher bond yields.
So on the one hand, we have a strong rebound in retail investment demand, and this was largely driven by a post-pandemic recovery, particularly in Asia, as economies continued to re-emerge from the pandemic. As a result, we saw a strong year-on-year increase compared to Q1 2020 levels, when many economies were affected by lockdown. Another key driver here was lower gold prices in many local currencies, which boosted gold purchases, especially given that many were still expecting gold prices to move higher later in the year. So on the other hand, we just talked about an acceleration in selling from ETF investors reported in the first 3 months. This was largely a reflection of a shift in investor sentiment towards gold since the beginning of the year, with gold being pressured by a firmer dollar, rising US Treasury yields, and growing optimism around economic recovery, supported by stimulus measures and the ongoing rollout of vaccination programs. As for central banks, A year-on-year decline in net purchases was largely a reflection of a sharp increase in gross sales, which was partly driven by growing pressures to raise capital in order to mitigate the economic damage caused by the pandemic.
The divergence in gold demand looks like it's set to continue through 2021, although the macro backdrop will probably remain broadly supportive for precious metals.
We expect retail investment demand to remain strong this year and to deliver a strong year-on-year increase, with gold remaining a robust portfolio diversifier, particularly in light of ongoing economic uncertainty, negative interest rates, and unprecedented stimulus measures introduced by central banks and governments around the globe. As for ETFs, we are likely to see a sharp drop in net inflows this year compared to a record level witnessed in 2020. We have already seen an acceleration in selling in the first 3 months, and further liquidation is very much possible in the coming months, particularly if we continue to see positive economic data, supporting a faster than expected economic recovery and a further rise in treasury yields. Overall, we expect a year-on-year decline in central bank purchases this year, but despite a year-on-year drop, central bank purchases will remain an important source of global gold demand. Demand is likely to be supported by the overall macroeconomic environment and the factors I have previously mentioned. Also, anticipated stimulus measures to revive the global economy will continue to support a strong case for central banks, especially in emerging economies, to diversify their international reserves away from the dollar towards gold.
Different investors have approached the gold market in extremely different ways, with retail demand picking up just when institutional investors started to take profits. Overall, the outlook for yields, and real yields in particular, remains key. Gold rises when real yields fall. The US 5-year real yield has just made a new all-time low. Inflation could easily spike in coming months, and the gold price could be explosive if it breaks those previous highs again.